what do you think of what Joe just had to say, and what do you think of what Mr. Powell had to say, more importantly?
Can I save what I think and what anybody thinks for a second here? Because I want to show you what markets think, which I think is a little bit more important and kind of will change the conversation. Markets this morning have sped up, and they're increasing their outlook for Fed rate hikes in the wake of that meeting yesterday where the Fed signaled a rate increase coming in March and likely balance sheet reduction sometime after that. Powell did not rule out consecutive hikes or limit to the number of hikes. Instead, he expressed greater concern over inflation and said there's scope to tighten policy without hurting the labor market. So rather than gradual hikes, that's the language the Fed has used in the past, Powell said the Fed needs to be nimble. Okay, here we go. While the market had been priced for quarterly hikes this year, that's 4 of them, Fed funds futures now see a high probability of 3 consecutive hikes at meetings beginning in March, a 4th one in September, and now a 5th in December. And just hold that chart up for a second there. First of all, I want to thank the graphics department. We only had a template for 4 hikes. We had to make the template this morning. Thank you, graphics department. That little break in there between June and September could be because the market thinks the Fed's going to halt hiking rates while it begins balance sheet reduction. Okay, anyway, this chart here would bring the funds rate from 0 to around 1.25% for one of the fastest rate hike cycles in years. No way to gauge market expectations for balance sheet reduction. Before the meeting, the CNBC Fed survey forecast $380 billion in runoff this year, $860 billion next year, $2.8 trillion in total over 3. Reading commentary this morning, I think the market is going to be penciling in more. We may do another survey fast. All right, step back. The big change here, the virtual withdrawal of forward guidance. That had offered the markets assurance of low rates while the pandemic was going on. How much the Fed does now is going to be tied to incoming data and the outlook, especially for inflation, rather than any long-term guidance. And that likely means ongoing volatility for stocks. So, Andrew, you asked me what I think. I think we're in for an interesting ride here. I don't know that these new hawkish ideas are right, and I don't know that the Fed means to do these things. What I do know is that when the inflation report comes out, we're going to have to adjust the Fed outlook to that inflation report. And when the jobs report comes out, we have to adjust to that jobs report. It's meeting to meeting, report to report now.